Congratulations, you've made it to the final episode of Master Mutual Funds: A Beginner's Guide. Throughout this series, we've covered everything, from understanding mutual funds to advanced investment strategies. But now, it's time to put everything together and create your own mutual fund portfolio. By the end of this video, you'll know exactly how to build a goal-oriented, well-balanced portfolio that helps you achieve financial freedom. Let's get started. To create a strong investment portfolio, follow these 5 essential steps. Define your financial goals. Define your financial goals. What are you investing for? Why is this important? Your investments should align with your financial goals. If you don't have a clear goal, you might invest in the wrong funds or withdraw too early. When it comes to setting your financial goals, it's important to categorize them based on the time frame. Short-term goals, which are 0 to 3 years, could include building an emergency fund, planning for a wedding, or buying a car. For these goals, debt funds and liquid funds are recommended. Medium-term goals, spanning 3 to 7 years, might involve buying a house, planning a vacation, or saving for your child's education. In this case, hybrid funds and balanced advantage funds are suitable options. For long-term goals, which are 7 years or more, like retirement, wealth creation, or funding your child's higher education, equity funds, whether large, mid, or small cap, are the way to go. Let's consider an example. If you're saving for a vacation 3 years from now, investing in an equity fund is, well, too risky. Instead, you should go for a hybrid or debt fund to protect your capital. Here's a pro tip. Match your fund type with your investment timeline to minimize risk and maximize returns. Allocate assets based on your goals, the 100-age rule. Why is this important? Your asset allocation determines risk and return. The right balance between equity and debt is crucial for stability. 100 minus your age equals the percentage of equity allocation. The remaining percentage should be in debt and hybrid funds. Example, if you're 30 years old, 70% in equity funds for long-term growth and 30% in debt funds for stability. So let's look at an example for a 50-year-old investor who is closer to retirement. You might want to consider putting 50% in equity funds and another 50% in debt and hybrid funds for stability. Here's a pro tip. Younger investors can take on more equity exposure, while older investors should increase their debt allocation for safety. Diversify, don't put all your eggs in one basket. Now, why is this important? Well, diversification helps reduce risk and increase returns over time. A good mutual fund portfolio should include large cap funds for stable, reliable growth, such as HDFC Top 100 and ICICI Blue Chip. Mid-cap and small-cap funds, which carry higher risk but have high return potential, like Nippon India, small-cap and Kotak Emerging Equity. Debt funds for stability and fixed income, such as SBI Short-Term Debt and ICICI Bond Fund. And finally, hybrid or balanced funds, which offer a mix of equity and debt, like ICICI Balanced Advantage Fund and HDFC Hybrid Equity. Here's an example portfolio for a 30-year-old beginner. 40% in large-cap equity, such as Nifty 50 funds, 20% in mid-cap equity for higher growth, 30% in debt funds for stability, and 10% in hybrid or ELSS funds for tax saving. Pro tip: a diversified portfolio ensures that even if one asset underperforms, others balance the risk. Rebalance regularly to maintain the right allocation. Why is this important? Over time, your asset allocation can change as markets move. You need to rebalance to keep it aligned with your goals. Review your portfolio at least once a year. If your equity allocation increases too much, shift some funds to debt for balance. If your debt allocation is too high, move some funds into equity for better growth. Example: if your portfolio started with 70% equity and 30% debt, but after a stock market boom, equity becomes 80%, you should rebalance back to 70% by moving some funds to debt. Pro tip: set a yearly reminder to rebalance your portfolio. Track and adjust, but avoid overreacting. Why is this important? Many investors panic during market crashes and sell at the wrong time. Mutual funds work best when you stay invested for the long term. Track fund performance every 6 to 12 months. Compare with the benchmark, like Nifty 50 or Sensex. If your fund underperforms consistently, consider switching. Avoid reacting to short-term fluctuations. Markets always go up and down. In March 2020, during the COVID crash, the stock market fell by 40%, and many investors panic sold. Those who stayed invested saw their portfolio recover within a year and grow beyond expectations. Pro tip: patience is key. Wealth is built over decades, not days. By following these 5 steps, you can create a strong, goal-oriented mutual fund portfolio that grows with you. Thank you for watching this entire series on Stock Glimpse India. I hope this series helped you understand mutual funds better and gave you the confidence to invest smartly. Which mutual funds are in your portfolio? Let me know in the comments. Don't forget to like, share, and subscribe. Your support keeps us motivated to bring more valuable content. Hit the bell icon so you never miss an update on investing and stock markets. Keep investing and let's grow wealth together. Summary of key takeaways. Step 1. Define your goals, whether they are short, medium, or long-term investments. Step 2. Asset allocation. Follow the 100-age rule for equity versus debt. Step 3. Diversify, including large-cap, mid-cap, debt, and hybrid funds. Step 4. Rebalance annually to keep your portfolio aligned. Step 5. Track and adjust, stay invested, and avoid emotional decisions. Now you're ready to build a powerful mutual fund portfolio.